Good Monday. This is Jay Brew, co-chairman of Seifried Brew. We've been working on a new book on enterprise risk management with Jimmy Sawyers, who we have a strategic relationship with in terms of creating an overall enterprise risk management system that you can see on our website, the description of that. But within that and writing this book on enterprise risk management for community banks, that one of the things that I did in one chapter is to revisit the duties of a community bank director. And as we've updated these moving through post-financial crisis, and now thinking again is that we're always evolving. Always thinking about how these duties of a community bank director start to shift as different things happen from a regulatory perspective, but also looking back is that what could have prevented the bank failures that we saw during that Great Recession. So let's review through the duties of a community bank director post-financial crisis. To preserve and build the bank's capital, to produce value for the bank's stakeholders through proper strategic planning. Once again, as part of that strategic planning process, that one looks at the risk and reward, one also looks at the projection of future capital and risk to that capital and being able to design a strategic plan that will essentially build that capital over time and to produce the value that the stakeholders will need. To create a capital plan that will come off of that strategic plan that will preserve, manage, and build the bank's capital. To set risk parameters within the capital plan that will preserve and build capital, which once again that ERM process is so very important in terms of, and will provide consistent earnings commensurate with the bank's risk parameters. To provide management with independent dynamic risk models. So when we put this together in terms of this assessment of risk, using risk models to sit there and say, well, what are the risks that we're seeing? What could happen with those risks? Is that we then think about event triggers. And I've talked about event triggers as part of the capital planning and strategic planning process. But now what I've thought of is that it must be a community bank director's duty to set event triggers to monitor the trends in risk so that we can be proactive in terms of our risk management. One of the things that I thought back on was at my bank embassy, that we would sit there and look at those economic event triggers. And we did that back in 2006, 2007. Coming in 2007 to 2008, we saw an increase in national economic risk, as well as an increase in Pennsylvania state economic risk. And we, as a board, said to management, what are we going to do in here to be proactive? Looking at the credit risk piece, that what we did is that we not only looked more closely at loans that were 30 days overdue, but we then went even further. We looked at the payment system in terms of the process, the dates the people made their loan payments. Did they change at all compared to normal? So that if they did change, that then the loan officer would contact those customers to find out if things were going okay. And my belief is that that helped us to have a much lower loan issue problem compared to the state and national averages during that time period. Once again, that's being proactive. But it was the event triggers that suddenly sat there and said, hey, you need to discuss this. Does there need to be actions that are taken? We look at both internal and external event triggers. So it can be ratios within the bank, for instance. It can also be from the standpoint of using like the Seifried Brew Total Risk Index and then looking at the breakout of those risks in terms of credit risk, liquidity risk, earnings at risk, and capital risk, so that if those trends go up above a certain level, that one can then sit there and say, gee whiz, what should we be doing in here? Should we be more proactive in terms of managing this risk? Is this risk acceptable? So when we look at enterprise risk management, my feeling is that event triggers are so very important in here. For instance, most recently, as interest rates start to move up on the long end, did that bring about discussion at your board in terms of what actions you should take? So that was triggered when the 10-year Treasury for our banks went over a 2.3%, and that then has continued as interest rates have continued to move up in here. We then look at adding this as being, once again, one of the duties of the community bank director to set those event triggers and then to monitor that trend in risk. Finally, we also put into the duties to evaluate the CEO's performance in carrying out the management duties of the strategic plan and the capital plan. To have a full understanding of all duties through education, questions, and discussion, and finally, to provide due diligence through proper oversight. And I feel it's always good to go over these on a constant basis, to sit there and say, do we need to add to this list of duties? Do we need to refine this list of duties? Because once again, when it comes down to those due diligence type of things that community bankers do, is that for directors, this is so very important. This is Jay Brew, co-chairman of Seifried Brew. Have a great week.